This meeting is now being recorded.
Hello, everyone. My name is Scott O'Brien. I'm the Senior Manager of Finance and Tax Policy at NBAA. Thank you for joining us today as we preview our Business Aviation Taxes Seminar, which will be held May 5th through 6th at the Omni Shoreham Hotel in Washington, D.C. On your screen, you can see a link to learn more about the seminar, and I'll just give you an update on a few of the new items for 2016. This year, to start the seminar on the evening of May 5th, we're featuring a reception from 6:30 to 8 p.m. at the Omni Shoreham, and this is a great opportunity to meet your fellow attendees and guest speakers and network. So we hope that you arrive in D.C. on May 5th and can attend our reception, and then the education portion of the conference will occur all day on Friday, May 6th. This seminar is designed to be a more in-depth look at tax and regulatory topics affecting business aviation, and we have a number of new sessions this year, including a business aviation market update from Rolls-Royce North America, a session that will discuss emerging federal tax policy issues and some of NBAA's work with Congress and the Department of Treasury to enact tax changes that have been requested by our membership. There's a number of new rules coming out regarding lease accounting standards from the Financial Standards Accounting Board, and we'll have a session that will review those rules and discuss the impact on business aircraft leases. And finally, getting to the purpose of our webinar today, we're having a session on challenging aircraft ownership and operating scenarios that will feature a discussion of the challenges when an aircraft is owned outside of a traditional corporate structure, maybe in a family office or in a company that has multiple brother-sister corporations, something that's different from a standard corporate ownership structure, and that's becoming more and more common in the industry. So we wanted to focus a session just on those issues. So joining us today to preview that session is Jed Wolcott, who's a CPA and president of Wolcott & Associates in Fort Lauderdale. Jed has been a CPA for many years focusing on aviation. He's worked for a commercial airline. He works on tax issues for Part 91 and 135 operators. He's been a member of NBAA's tax committee and is a frequent speaker at our events. So Jed works with a wide variety of clients, many of whom don't have the traditional corporate ownership structure, so he's got a great amount of expertise on the topic. Also with Jed is his associate, Sue Filkringa, who is a CPA and also an airline transport pilot. She's with Wolcott Associates as well, and Sue is an aircraft owner and works as well with a number of clients, Part 91 operators, Part 135, on a variety of tax issues dealing with both structuring the aircraft ownership and also tax issues that come up during the ownership cycle. So with that, I have a few questions for Jed and Sue that will help you get an idea of what they're planning to cover on May 6th. So our first question is, many NBAA members report that owning a business aircraft within their traditional corporate structure is a challenge. Can either of you briefly describe the most common situations that make owning an aircraft in a corporate structure challenging?
Scott, first off, there are at least 4 government regulatory and tax agencies that oversee or have a hand in aviation. There is, of course, the FAA. We all know about that. Then there's the Department of Transportation. And when we get into the tax reporting side, we have the Internal Revenue Service, and almost every state has their own set of rules for state sales taxes or use taxes and or personal property taxes. So each of those groups have their own rules, and they don't really talk the same language. The rules overlap. And sometimes are even in conflict with each other. So keeping all of those agencies and their rules sorted out and all moving in the same direction is really a challenging undertaking. It starts with structuring the ownership of the aircraft, and then once the aircraft is integrated into a company or a family operation, a family office, for instance, then there is the task of keeping the aircraft operating within the rules and within the guidelines as time goes on. So all of those outside agencies have a hand in regulating and governing the use of the aircraft, and all of those masters have to be served.
The best practice for owning a business aircraft is typically when it's owned and managed by the operating company that uses the plane in their business. That's really what the FAA and the IRS are expecting to see when you have a business asset. Just like anything, a punch press, a computer, those types of assets are listed for a business.
Sometimes that structure just isn't practical. However, we do prefer to see the aircraft inside an operating company, but conditions, social issues, financial issues can sometimes come into play, which complicates the ownership structure. Maybe the aircraft is owned by the owner of the company and not the company itself. Or maybe a non-owner chief executive officer owns the aircraft and leases it back to the company. All of these complications are just that. They create additional situations that have to be dealt with in order to maintain compliance with the FAA and the IRS and the state reporting agencies. So all of those changes have tax consequences and regulatory consequences that have to be observed and attended to.
Thanks, Jen and Sue. So with those considerations, is it important to engage with your advisors early on in the acquisition process, especially if you have a complex structure, or is this something that you can wait on until maybe after you've purchased the aircraft? How does the planning process flow, if you could just briefly describe that for a more complicated structure?
Definitely you want to get on the planning for the structure early on in the purchase cycle of the aircraft. That's where you end up spending quite a bit of time, and we end up spending our time because every structure is unique. People have different things going on in their business life and their personal life and have perhaps trusts involved with the family office, and perhaps they still have a stake in the business that they were previously managing or previously owned. So all of that takes a lot of consideration to make sure that you do have the proper structure in place before you even get off the ground.
Great. Thanks. So our second question is, family offices are often involved in business aviation through aircraft ownership or leasing. What are the most important tax considerations for a family office when considering business aviation?
Well, aircraft are expensive assets, and the people that are using these assets in their family office are used to taking depreciation on them. So that's one of the big tax breaks that a business gets with a business aircraft. So a basic tenet of the Irs Regulations is that expenses have to result from business activities in order to be able to write them off. And suddenly, if you've got that aircraft in a family office where that is the only business that's happening, is maybe writing checks and taking care of the family, that's no longer a business, and that's what we have to structure around. The things that we're guarding against or that we're looking out for, of course, are reimbursement rules. We don't want to over-reimburse. We've got hobby loss rules. We've got personal use rules, passive loss issues, all of those things that are typical even in a business structure, but it takes a lot more planning when it's a family office structure.
A lot more focused in a family office.
And are you seeing an increase in the number of family offices owning aircraft? Is that something you've seen a change in over the last few years?
We do see that. A typical scenario would be an entrepreneur that owns a business, created it perhaps from scratch or inherited an existing operating company from a parent. They run it for a while and then they sell it and retire and are no longer have a operating business to manage. So they create a family office to manage the proceeds from the sale of the company and purchase an aircraft or inherit it from the company, and then they come to us and they say, well, how can we write it off? And sometimes we find ways to do that, and sometimes it is a real challenge.
Thanks. Our final question is, in a traditional corporate structure, business aircraft costs can generally be shared across various divisions. Why are reimbursements or cost sharing a challenge in a non-traditional structure like the ones we've been discussing today?
Scott, the FAA prohibits owners of aircraft from selling air transportation. That is a right that is afforded only to airlines or licensed charter operators. So billing other people, other companies, even other divisions becomes problematic. The FAA does allow a certain amount of cost reimbursement in certain circumstances. There are methods that reimbursements can be made. Those reimbursements are sometimes subject to tax consequences, but the reimbursements are never enough to actually cover the full cost of operating the aircraft, or seldom are they. So we do have challenges to overcome. Sometimes rather than charter internally the aircraft, we have to resort to alternative structures that involve leasing, for instance. But there are rules that are really quite challenging in reimbursing for the use of business aircraft, and we spend a lot of time keeping our clients sorted out in that regard.
Great. Well, thank you, Jed and Sue. Again, here's the specific details on our event, May 5th through 6th, the Business Aviation Taxes Seminar in Washington, D.C. We hope you found this preview helpful, and we look forward to seeing you at the event. Thank you again to Jed and Sue.
Thank you.
Thank you.